Good day, everyone, and welcome to a podcast that we have with a very special guest. His name is Howard Marks. Howard is a legend, actually, in the investment industry, where he started in 1969 and continues to be very active in the business as the co-founder and co-chairman of a large asset management group called Oaktree, based in the U.S. We're very privileged to have Howard. Let me give you some background on Howard. So as I mentioned, Howard started in the investment industry in 1969 and went through a variety of senior roles, at the same time developing a skill set in particular in distressed assets, particularly private credit. He and his colleagues created Oaktree in 1995, and I believe at the time they had approximately $5 billion of assets under management. And if we take a look at the situation today, we'll see that it has increased significantly. But before we look at that, let's consider some of the things that Howard has done outside of actually actively investing people's funds. These are two books that were put together by Howard, I think 2010 to 2012, called The Most Important Thing, Common Sense for the Thoughtful Investor. And as you can see, one of his raving fans is Warren Buffett. And then a few years later, I think in 2018, Howard wrote the book Mastering the Market Cycle, and I can certainly endorse this book. It's a wonderful book on understanding the kinds of cycles one has to look at in terms of investment strategies. A little bit more about Oaktree. As I mentioned, started in 1995, now at about $172 billion of assets under management with 1,100 employees plus, stationed literally all over the world in a variety of different marketplaces. Their strategies are focused on credit, private equity, public equities, and real assets. And what triggered my desire to have a discussion with Howard today was a very important memo that he writes these memos on a regular basis, I think pretty well every week to 2 weeks. And this particular memo came out about 2 months ago. It's called Sea Change. And this is really what we're going to primarily discuss today. It really means a profound or notable transformation. So with that taken care of, maybe I can come back and introduce you to Howard. Howard, thanks so much for joining us today. We very much appreciate you taking the time to be able to make this possible.
Well, it's a pleasure to be here, John, and to be working with you and your firm and your clients. And I hope our discussion today will be helpful to people in understanding the environment.
Well, I'm very sure they're going to be very insightful. And we will arrange, if you want, to get a copy of that memo that Howard wrote called Sea Change, which I think you would find extraordinarily enlightening. So, Howard, maybe I can start with this question. I mentioned you started in the investment industry in 1969. And at that time, you described the importance in portfolio management of understanding what was then called the Nifty 50. Can you maybe explain a little bit about what this was?
Well, the Nifty 50 were believed to be the best and fastest growing companies in America. Prior to the 60s, most investment was in stable traditional companies, industrial companies, transportation, utilities, and that kind of thing, railroads. Roughly in the 60s, investors started to focus on something called growth investing and growth companies. I remember being in my dad's apartment in 1963 and seeing the first brochure on growth stocks. And that's what the Nifty 50 were believed to be. IBM, Xerox, Kodak, Polaroid, Merck, Lilly, Avon, Coca-Cola, etc. Companies that were considered to be so good nothing bad could ever happen, and so good that no price was too high. And if you bought those stocks the day I reported to work in September of 69, and if you held them firmly with patience and discipline, in 5 years, you lost about over 90% of your money. Because no company is so good that it can't have negative developments, and no company is so good that it can't be overpriced and dangerous. And so I learned a very valuable lesson from that. You can learn these lessons in the books all you want. Living through it is a different kind of lesson. And what it taught me was that it's not what you buy, it's what you pay. And there is no asset so good that it can't be overpriced and dangerous. And there are very few assets so bad that they're not a buy at some price. And so this was a change in my thinking and a change in the world's thinking at this time. Rather than saying these are good assets and these are bad assets, we switched to saying, well, yes, it may be risky, but the promised return or the expected return more than compensates for the risk. So I'm going to do it. And the whole industry runs today on risk return thinking properly. And without it, we wouldn't have private equity, venture capital, and many other forms of investing.
Right. So, Howard, would you see that as essentially a form of what would be known today as value investing as opposed to growth investing?
Well, the Nifty 50 were growth stocks, selling at very high prices with meaningless dividend yields and very high PE ratios in the present, but highly valued because of all the rosy things that people saw down the road. So that's called growth investing. And value investing basically means buying things for less than they're worth and garnering that value. You buy something for less than it's worth, it goes to what it's worth, you make up the difference and you move on.
Right. So, back in 1974, when they had dropped that much, many of these companies are still in existence. I presume at that point in time, your view of these companies would have been to consider acquiring them.
The problem is, yes, you're right, John, but the problem is that, number one, most people had no money left because if you have all your money in the Nifty 50 and they crap out, you'd like to average down, but with what? And then the other thing was that people had their confidence blasted. And when you buy something at 100 because you love it and it falls to 10, it's hard to go back in and buy more. You should usually, that's one of the main things Oaktree does is turn super aggressive in panics.
Right.
But it's hard. It's hard.
But if you think about your return over, let's say, an extended period of time, how you react during a crisis is probably one of the biggest drivers of your long-term performance, is it not?
Well, it certainly is. First of all, that's a really good observation. First of all, the worst single thing you can do as an investor, and there are many ways to make mistakes, and there are many things you can do wrong, but the worst of all, in my opinion, is having bought something and having seen it deteriorate in price, selling it just because it's down. Let's look at the market overall. You buy in, it drops 30%.
Mm-hmm.
That's really okay if you're patient, because chances are the next high is going to be higher than the last high. And the economy and the market benefit from an upward sloping secular trend line.
Fair enough, yeah.
So buying high and having it fall is not the worst thing in the world, because the next high is probably going to be higher. The worst thing in the world is buying high and having it fall and selling it, because then you don't participate in the recovery.
Right.
So I describe this as the cardinal sin of investing. Alternatively, if you can muster the nerve, buying on the low is a very important way to make money, in my opinion, safely.
Right. So in a way, you're saying the positions you want to take are essentially intended for a relatively long time. So you're not in a trading mentality. You're not buying and selling all the time. And that means then that you're, by definition, I would say, you're not actually market timing. You might be price timing, but you're not market timing.
Right. Well, that's a very good distinction. I haven't heard it before, but it's a good one. We have a very simple investment philosophy that governs everything we do. It has 6 tenets, one of which is that our investment decisions are not dependent on macro forecasts. It would be nice to be able to forecast the macro. The macro is very important. The only thing is it can't be done. Nobody really, with the occasional exception like George Soros, nobody can really time the market and add to results by getting in and getting out and getting in and getting out. Being in is much more valuable than trying to to be cute and get in and out. I mean, there have been a few instances in my life when it was important to turn more conservative and when it was important to turn more aggressive, but only a half dozen over 50 years.
You indicated in the memo at the beginning of it that this change from 69 to 74 was, I guess, your first sea change experience in the industry in the early 70s. So can you expand on how you arrived at this secular moment where what had worked a certain way is now different?
As I say, I joined the industry in 69, and in 69 there were absolute standards for proper or fiduciary behavior. And if you were a fiduciary and you behaved in a non-fiduciary way, you could be penalized, surcharged. In particular, to illustrate, if let's say there were 10 speculative bonds, B quality bonds, and a manager bought them all, and 9 made money and 1 lost money, he could be surcharged for having bought the one that went down, without reference to the fact that the other 9 went up. So you couldn't defend your actions on the base of portfolio. Each transaction had to stand on its own. Today, we look at everything from a portfolio point of view, and it absolutely is considered fiduciary behavior to make investments because they may be risky but well compensated. So that's a big change. And what really kicked it off more than anything else was the juxtaposition of the collapse of the Nifty 50, which mostly occurred in 73-4, and then the arrival of high yield bonds in 77-8. You know, Mike Milken, who was the greatest proselytizer for high yield bonds, his key conclusion, well, he found a book called Hickman was the author, about the performance of bonds between 1900 and 1944, which of course included the Great Recession, and the book shows that in this period, the lower the quality of the bonds you bought, the more money you made, even during the damn Depression. So taking risk, it can be done wisely. That's the key. Taking risk is not on its face a mistake. That was a big change, and that's why we have this risk return thinking today, thanks to that development. So that was a big moment in the world, and that's what we all do today.
So in today's terms, for example, I mean, if the additional premium you're getting, let's say on a yield on a higher risk debt than lower risk debt, is higher than a default rate, then by definition you would end up with a positive or accretive return over the low risk investment, right?
Exactly. If I can take a minute, John, your audience may enjoy this, but so I started doing this in 78, and around 81 or 82, one of the first of the financial cable networks interviewed me, and the reporter asked me a brilliant question. She said, "How can you buy high yield bonds when you know some of them are going to go bankrupt?"
Yeah, okay, fair enough.
And this was one of these occasions that we like so much when we come up with the right answer on the spot.
Yeah.
And I said to her, the most conservative companies in America are the life insurance companies. How can they insure people's lives when they know they're all going to die? It's an absolutely analogous question. So let's think about the life insurance company. Number one, it's a risk they're aware of. They're not shocked when somebody dies. They know that some percentage of their insureds are going to die every year. Number two, it's a risk you can analyze. And when I got my first life insurance policy, they sent a doctor to my house to examine it. Number three, it's risk you can diversify. So no insurance company insures only people from Massachusetts or only people from California or only people who live in the San Andreas Fault or only skydivers or only smokers. They diversify their book of business, right, to get a more predictable outcome and to avoid disasters. Number four, it's risk they're well paid to take. They have an actuarial prediction of when you're going to die, and they assume you're going to die then, or maybe a little sooner, and they set a premium for you such that they'll make money even if you die. So I would call this the intelligent bearing of risk for profit, and it's what we try to do. Risk we're aware of, risk we can analyze, risk we can diversify, risk we're highly paid to take. And that approach beats the hell out of avoiding risk and hoping you can have a decent return without risk, because that's not possible.
So, Howard, it's really interesting because it basically, it really focuses on investments being a probability game, and your understanding of exactly what those outcomes are likely to be, and having a margin of error. I know from my own experience in the life insurance industry that the life insurance industry basically hasn't got any risk from the company's perspective. It's far less volatile than property insurance or health insurance or any other insurance field. So the life insurance field is pretty well a guaranteed annuity to the companies that actually issue the insurance in the first place. So really not taking much in the way of a risk at all.
Right. Yes, and especially, Oaktree primarily invests in fixed income instruments, bonds, loans, notes, and I don't know, every investor should thoroughly understand the existential difference between stocks and bonds. When you're an investor in the bond market, your return comes from the contract between you and the borrower. They borrow money, they promise you interest periodically, they promise your money back at the end, and oversimplifying, if they don't keep the promise, then you get the company. So they have a lot of incentive. To pay you as promised. Now let's flip over to the stock market. Here, there's no promised return. There's no contract. You're just one of the shareholders, and you're entitled to your share of whatever the shareholders get. But it could be zero, it could be negative, it could be positive. Mm-hmm. And so you're just a remainderman, and how you're going to do is extremely uncertain relative to the bondholder. So our returns are contractual and quite dependable. And by the way, you mentioned that we get paid a risk premium for going into lower grade credits. In our high yield bond portfolios, which have been operating for 45 years, I don't think there's ever been a year in which our credit losses consumed the whole spread. So in other words, every year for 45 years, the risk premium has been more than adequate to cover the risk and provide a performance increment.
Right. Okay. So, this brings me to this question. Like starting in the late 60s and 70s, inflation and interest rates rose continuously all the way through to 80, 81, 82. And then I think they got 13.5% inflation and 20% interest rates by 1980. Now, in that environment, in the entire decade there, were there any areas that asset classes that could at the time generate strong positive returns, or is it just impossible when that much headwind is in front of you?
I think it was impossible. Now, of course, in the investment world, certainly today, maybe then, there are ways to take a contrary bet. So rather than owning something, you could short it.
Right.
And if ownership loses money, then by definition, shorting makes money. But not many people do that. It's hard to do. And by the way, most of the time the market goes up and being short is a mistake. So, but barring that, I think it's safe to say that in an inflationary environment, or especially not merely the existence of inflation, but when we shift from a low inflation environment to a high inflation environment, which is quite traumatic, I think basically all assets do poorly. And if you look at last year, it was one of the worst years for stocks. It might have been the worst year for bonds on record. It was the first or second worst year in history for the combination of stocks and bonds.
Oh yeah, it was.
And we know that real estate didn't do great and so forth. So there was really no place to hide last year unless you had enough skill to offset the general trends. And let me just say, to lay the groundwork we may use this later in the discussion, a market or an asset where its performance is entirely a function of the general trends, that's what we call a beta asset.
Right, market based.
And an asset where a substantial part of the performance comes from the skill of the manager in selecting and managing assets. That's what we call an alpha market. And that's a very important distinction. And of course, when things are going well and everything's going up, you can't distinguish between an alpha market and a beta market. You can't know who made astute, good decisions and who surfed the trend and got lucky.
Yeah.
Buffett says it's only when the tide goes out that we find out who was swimming naked. It was only when things get tested that we find out who was surfing a bull market and who was really making astute investment decisions.
So, I mean, Howard, you, for example, you and your firm wouldn't necessarily have predicted in 2020 or 2021 that inflation and interest rates would rise so fast and so far as they did last year. But I make some reasonable assumption, in your case, you position yourself to be prepared for unforeseen events. So how do you do that? Like, how does that strategy come about?
Well, it's great that you should say that, because it puts me of a mind of a memo I wrote roughly 20 years ago called "You Can't Predict, You Can Prepare."
Mm-hmm.
This was the tagline of the Mass Mutual Life Insurance Company. They used to use that line when they advertised on the football games.
Yeah.
And it is challenging. It's like a challenging riddle. What does that mean? You can't predict, you can prepare. How can you prepare for something if you haven't predicted it? And the answer is that you can put together a portfolio. You know, what some people do is what I call single scenario investing. What will happen to the economy, to the interest rates, to currencies, to commodities, to the market? Which assets will do best in that environment? Let's buy a bunch of those. That's planning on a single scenario. But you mentioned before that investing is a matter of probability distributions. So you can think about the range of the things that may happen. Not necessarily every possible thing that could happen, not the things that are in the unlikely tails, but what are the things kind of in the middle of the distribution that could happen? Let's put together a portfolio that will do well if the best of those happens.
Yeah.
And not too badly if the worst of those happens. That's the way you can prepare for an uncertain future. And there's nothing wrong with saying, I think A, B, C, and D are likely to happen. E, F, G, and H, not likely to happen. I think that A is the most likely, B a little less, C possibly, D maybe. And so you prepare a portfolio for a variety of eventualities. That's called diversification. Everybody thinks that diversification is prudent and a good thing to do. But what it really means is we concentrate our investments to take advantage of what we know, but we diversify our investments to protect against what we don't know. And hopefully you are in the investing world because you think you know something, and hopefully you do. But hopefully, by the same token, you say to yourself, I don't know everything. My foresight is not 20/20, so I'm going to diversify to protect against my ignorance. And we all have. It's very important that we all admit that we have some ignorance.
Well, Oaktree invests in a variety of strategies: private and public equity, private and public debt, and then real assets. I'm assuming by real assets we're talking at least some real estate included in that infrastructure. So how do your senior people, you and your senior team, make a decision about what you think at any given moment the overall asset allocation should be, and what you're recommending for client, and then maybe tied to that, tactically, how does that drill down into the way you're executing at each sub-asset class level?
Well, I'm the guy whose main responsibility is to set the macro tone.
Mm-hmm.
And as I said before, we don't do this on the basis of forecasts. We do this on the basis of what we observe going on right now. So I think that the main dimension for making macro decisions is the spectrum that runs from aggressive to defensive. And each of us, each of our clients, each of your clients, each of their clients should have a sense for what their normal, proper risk position should be. Ranging, let's say, I talk about it ranging from 0 to 100. 0 is no risk, all cash. 100 is full risk, fully invested, maybe levered, and aggressive strategies. So each client, where should they be from 0 to 100? That's your normal risk position. And then the question is, today, given conditions on the ground, should we be more aggressive than usual or more defensive than usual? That's my role. But you have to bear in mind, I talked a minute ago about the importance of acknowledging your ignorance. Most of the time, we're in the mid-ground where things are not too overpriced and should be sold, and they're not too underpriced and should be bought. They're kind of in the middle. They're in the zone, what I call the zone of reasonableness. But I established the framework, in the 2010s, we were in a low return world where there were not great offerings for the lender. And so our mantra for at least 10 years was move forward, but with caution.
So if you separated the alpha between, let's say, what you just discussed, which is the global macro asset allocation decision, defensive versus offensive and so on and so forth, against your tactical execution of choosing, in a neutral market, are there value propositions there that are outliers in that market that give you that opportunity? Like, of those two factors, does one have more importance than the other?
Yes, I think clearly the latter. My second book was called Mastering the Market Cycle, and I worked on that with my son, who's a brilliant venture capital investor. And I said to him, Andrew, I think I've been about right on my market calls over the course of my career. And he said, yeah, Dad, that's because you did it 5 times in 50 years. 5 times in my career, things were crazy high or crazy low that you could strongly argue for action, and you had a high probability of being right. But if I had tried to do it 50 times or 500 times, my batting average would have been much lower. So the point is there are not frequent opportunities to make a big move one way or the other and be right. So in between, the way we are right is by knowing more about the micro than other people, companies, industries, and securities. And we're what's called bottom-up investors, where we don't have a strategic view of what's going to happen in the world and try to populate a portfolio on that basis. Rather, we just try to find the best bargains we can. And
so that's the grinding work that the filtering work that has to make you. Yes. That's where the hard effort comes in looking at a lot of what do they call it? You have to look at a lot of frogs before you find a prince.
Right. Yes.
So now you talked in the memo about this. We've had this 40-year cycle till the beginning of 2022 of a bull market, both in stocks and bonds, which is secular in nature, and in the case of bonds, can't be repeated for obvious reasons. We're not, unless we go back to 20% interest rates. So if that's the case, from at the end of last year, beginning of last year, to looking forward, what do you see that changing in the way that you're taking a look, both from an asset allocation perspective, and in particular, any specific asset classes that you're involved in that you would want to have a higher focus on or higher concentration in?
Well, I hope the listeners will get the memo. You'll provide it to the ones who ask. And by the way, all the memos are available at oaktreecapital.com under Insights. I always stress that the price is right because they're free.
They're great.
But the thesis of the Sea Change memo is that we are going into an entirely different environment. We are in and will be in an entirely different environment for the next several years. I can't tell you exactly how many. But the point is, I'll bet you that, basically, John, you have to be our age to have lived through a period when interest rates were not either declining or ultra low. For the last 40 plus years, interest rates declined and ended up at zero. And declining interest rates, I say in the memo, are like a moving staircase or an escalator or whatever you want to call it. But when interest rates go down, the prices of assets go up because a cash flow of a given magnitude has a higher value. The value of bonds go up for the same reason. It's easy to run a business. It's easy to make money in your business. Your cost of capital is declining all the time. It's hard to default. It's hard to go bankrupt. It's easy to raise additional money for your company, either to grow or to replace money that you've burned up through losses. And so that's the climate we were in for 40 years, and especially for the 13 years from '09, when the Fed took the Fed funds rate to zero to stimulate the economy, until the end of 21, before people accepted that inflation was not transitory. So that was, I described this as an easy period, abnormally easy. B, it was bad for lenders and bad for bargain hunters, which is what we are. It was good for borrowers and good for people who owned assets.
Right. So harder for you guys to add value in a period of time when the wind is behind everybody and moving them all along at a pretty good pace.
You know, we do. I'm proud that we do pretty well in the good times, but we do exceptionally usually in the bad times. So, arguably, our performance in the long run is the average of keeping up with the market when it does well and doing much better than the market when it does poorly, so that on average we do better than the market. But clearly, our real significant accomplishments come in the tough times.
Yeah, and it would be interesting. Actually, it would be great. I mean, I'm not running your marketing department of any kind, but we did a presentation just recently, and we have, let's say, a long-term balanced portfolio outperformance over what we'll call the beta. So we have an alpha spread ourselves in terms of the last 25 years. What we wanted to focus on in particular is how much of that was earned during a period of crisis. So we took a look at our returns in the dot-com bubble, the GFC, the COVID meltdown, and then of course obviously 2022. And that gap, where if the average gap was 2.5% a year, that gap was closer to 7% a year in those periods of time. So that's really where the difference was made in that period of time. And I think you guys, it would be great to see your track record imprinted with those key periods and say, this is the outperformance when it matters.
Yes. Well, and that's really the key word, when it matters.
Yeah.
Everybody wants their investment manager to outperform. If you think about it, most of us investment managers have inherent biases, and we have people who are basically optimists and basically warriors. And the optimists generally have risky portfolios, but make a lot of money when the market does well.
Yeah.
And the warrior has a cautious portfolio and shines when the market does poorly. Very, very, very few people can do both. Very few people can have a conservative portfolio when the market does poorly, but then switch to an aggressive portfolio and participate enormously in the bull market, and then switch to a cautious portfolio and be safe in the bear market. That it's really expecting too much for anybody to do that, and very few people throughout history have done that. Which is more important?
Yeah, agreed. And Daniel Kahneman expresses in behavioral finance and economics that people basically can't control their own urges in terms of so their own behavior is more important to their returns than most other things.
Right. But what does that mean? That means everybody who's listening to this should sit down and say to themselves, what kind of person am I? And am I inherently optimistic or pessimistic? And how can I kind of water down my biases to be more objective? And if you're a worrier and the market starts to tank, how can you keep from throwing in the towel? And how can you when the market's down 60-70% or any given asset, how can you use that as the opportunity to turn aggressive and buy like crazy?
It's very difficult because I don't know if you're familiar with Dalbar and the studies they do about investor behavior. They're out of Boston, and they've been doing this for decades.
Yeah.
And they take a look at the average. They look at 10,000 individual accounts, and they measure transactions and performance against basically beta returns. And essentially, on average, over 20 years, investor performance is 3 to 4 percentage points below the actual return for the market itself. So if all they did was buy the market and do nothing at all, their returns would be 3 to 4% a year higher than they actually are.
Yes. Well, when I went to graduate school at the University of Chicago, they had just started to do their groundbreaking work in investing. And one of the things my professor pointed out was that the average mutual fund does worse than the S&P before fees, and then they charge a fat fee for doing that. So, so he said, well, why not just buy one share of each stock in the S&P? There was no index fund at that time or indexation, but the point is that indexation and passive investing has now taken over the majority of equity mutual fund capital. I hasten to say, not because passive investing is so good, but because active investing was so bad.
Well, and the weird part is I think some of the benchmarking issues are asset managers have basically they are effectively following the market and afraid to be out of certain parts of the market. So essentially, they're closet indexers with transaction costs and fees.
Yeah,
When
exactly.
the studies that the managers on equities that are involved in what are called high active share, where they have concentrated portfolios and a certain limited number of companies, and they've done great analysis, they actually do outperform the marketplace. But as you point out, only a fraction of managers can add alpha to the market that they're investing in.
Well, by definition, if you don't have active share, if you don't have some preferences and concentrate on those, you can't earn your fees. If you have opinions and you concentrate on those and you're wrong, you also don't earn your fees. So in order to make a positive contribution to your clients, you have to be active in, as you say, selecting individual assets and concentrating in them, and you have to be right. And not many people can do it, and so only a limited number of asset managers really earn their fees.
So, coming back to today's environment, how important will the impact be of the defaults of these three regional U.S. banks and effectively Credit Suisse as well, in terms of both markets and maybe in terms of, let's say, investment strategies going forward?
I think that the failures are not systemic, which is to say that the failure of Bank A in this case doesn't threaten Bank B like they did in the global financial crisis when we were worried about what was called counterparty risk. So I'm not worried about a meltdown from contagion. What it should do and may do and arguably has done is elevate risk aversion among financial participants. Participants in the markets are supposed to be risk averse. Mm-hmm. Humans are supposed to prefer safety over risk. And so so they're supposed to prefer a safe 7 over a risky 7, and maybe a safe 7 over a risky 8.
Yeah.
And sometimes investors forget to be risk averse, and they forget to avoid risky strategies, and they forget to demand sufficient compensation for engaging in risky strategies, and that's when they get in trouble. So the point is, I think that the bank failures have somewhat elevated the level of risk consciousness, which is a healthy development. The riskiest thing in the world is the belief there's no risk. And,
Right.
because when people think there's no risk, they'll engage in risky practices, buy things at prices that are sky high, and the world gets into trouble. And I think that's not the case now. The beauty of today, after the sea change which has taken place, is that today, unlike the last 13 years, today credit instruments, fixed income securities, debt securities offer very juicy returns comparable to the returns you can get from equities. And they do it on a contractual basis.
Mm-hmm.
So that's really a great opportunity. The opportunity to put money out to earn 8, 9, 10, 11, 12% on a contractual basis with limited credit risk is a great opportunity. And it's one we haven't had for the last 14 years. So
I was just going to say, you would see, so I mean, even this short-term banking issue is going to have an impact on other banks, not necessarily from whether they default, but in terms of what their lending practices will be.
exactly.
And that will impact your opportunities in terms of private credit, I'm assuming.
Right. And, investing, you have to think of investing as a dynamic field where the game is affected by the behavior of the players. The game is not static. And the opportunities that are available to me are largely a function of the behavior of my competitors.
Mm-hmm.
So if my competitors, the other lenders in the world, are hot to trot, eager to put money out, they feel that if they invest the money they have today, they can go out and raise more and become a bigger firm, and so forth. If they're eager to go, then the opportunities that are available to me will be paltry, because their buying will drive prices up, and
Right.
their low standards will make high standard investments unavailable. So we love to see other people pull back from lending, because if they don't compete to put money out, we can demand higher returns and more safety.
So this environment that we're in now, and presumably, well, it depends. Well, I should ask you what your thoughts are. We have this inverted yield curve, and in theory, that's a precursor to a recession. Is that your thinking?
You know what? I don't follow that. I don't think it's. Nobody's ever been able to suitably explain to me why it should work. In the past there has been some coincidence between inverted yield curves where the 2-year bond has a higher yield than the 10-year bond, and recessions. But I'm not going to use it as an indicator until somebody can explain to me the causality.
Okay, fair enough. So it's not your expectation, or because if that's not something that you would use, let's say, as a predictive tool,
Right.
then
Right,
essentially,
right.
then do you think about, again, from a macroeconomic perspective, say, because in theory, a recession is an opportunity, a better market for what you do in private credit than, let's say, a relatively strong economy.
Absolutely. And by the way, John, I do believe that there will probably be a recession, because that is this normal impact of the kind of rate increases we've seen.
Right.
Interest rate increases. When the Fed wants to get the economy going more peppily, it stimulates with what we call accommodative monetary policy, lowering interest rates and buying securities, which puts money in the hands of investors. When they want to cool off the economy, they raise interest rates and they tighten the liquidity. And that's what they're doing now. So non-accommodative monetary policy usually leads to a recession. So we're preparing for a recession based on that being the norm, the normal repercussion of today's behavior. That doesn't mean it's going to happen, but as we talked about before, one can't ignore the very strong possibility.
Yeah. So again, coming back to your desire to invest on a probability basis.
But you're absolutely right that the bargain hunter gets more access to bargains in bad times than good times. In good times, every asset holder is happy and thrilled with the way things are going and complacent and optimistic. And why would they send you anything that you could buy on a bargain basis? It's when they're depressed and they're afraid that they've lost a lot of money and they're afraid of losing more. That's when you can get bargains. And we're closer to that today than we were a year ago or 2 years ago.
Now, you have offices literally all over the world. So I make the assumption you also invest on a global basis. Is that correct?
Well, we do. We're still heaviest in the U.S. because the U.S. has a great combination of a strong economy and the rule of law. And since we're creditors, and if we don't get paid, we have to sue for what we have coming, whether it's in bankruptcy court or elsewhere, we need the rule of law. And by the way, a lot of people are questioning today whether China is investable. I happen to think it's investable. It's investable if you're careful. But my partner Bruce Karsh, who runs a lot of our most important portfolios, said the other day that he'd rather, if he had a lawsuit, he'd rather do it in China than in Italy.
Oh, really?
Yes, our experience so far has been we have the rule of law in China. Everything we've ever done there has gone as it should have from a legal process point of view.
Okay, so and that's the disconnect, as you say, with the headlines, because the headlines suggest something like the opposite is true.
Well, look, here's how I'll illustrate it to your listeners. There are two piles of assets. On one pile are assets that everybody knows about, understands, feels good about, feels are respectable, and is optimistic about. On the other pile, you have things that people don't know about, don't understand thoroughly, feel are a little bit unseemly. They don't, and they're pessimistic about it. Where are you going to find the bargains?
Right.
You can't. It's an oxymoron to say that you're going to prospect through the most loved assets and find some bargains. The bargains are on the reject pile. And I've made my whole career doing things other people didn't want to do, high yield bonds and distressed debt and things like that. And when other people aren't bidding for them, the price is usually low relative to the real value and does not incorporate much optimism. So by definition, all the surprises will be on the upside.
Okay.
And we try to arrange our portfolio so that the surprises are on the upside. And the best way to do that is by paying low prices for out of favor assets.
Whether you're acquiring equities, private or public, or debt, public or private, does environmental, social, and governance standards, do they impact the decision or that you make about whether you're going to acquire asset A versus asset B?
Absolutely, John. I have stood strongly for responsible behavior, ethical behavior, all my whole career. And I'd rather be known for that than be known as the world's greatest investor. I believe, and always have believed, that each of us and our companies and our organizations have responsibilities to our fellow citizens of the world that go beyond just trying to make money and just following the laws. And I believe that corporations should be contributors to society, which includes looking at environmental and social and governance matters. So, we've always taken the environment into consideration. in the last few years, we've formalized that, and we have a head of ESG, as most people do. We're a little bit unlike some other investors because ESG investing is really just evolving and starting, and it certainly has not reached a consensus yet. But a lot of people think that to be an ESG investor, an environmentally sensitive investor, you must sell the things from your portfolio that are violators. And the best examples, of course, are oil and gas.
Right.
So you want to get the fossil fuel securities out of your portfolio. I don't believe in that, taken by itself. Because let's say that I sell my oil and gas stocks to you. How has that made the planet better off?
Yeah.
It's not like if I sell them, they go out of existence, somebody else buys them. That's one. But even more importantly, let's think about who buys them. The person who buys them is somebody who cares less about the environment than I do, and consequently is somebody who is likely to run those companies in a more polluting way to make more money. So moving assets from strong environmental hands to weak environmental hands doesn't help at all.
No,
I think the way to help is to make things better. So for example, we'll invest in an energy company if we can get influence with it and make them better behaviors. And I think that does more for the world than just deleting and boycotting.
It's interesting you mentioned this because I remember reading a book, and I'm trying to think maybe it was one of the early Peter Drucker books, and he was just reflecting on the demise of the railway industry, the passenger railway industry, through the early 1900s and through the 1940s and 50s, especially as cars and planes became the mode of transportation. And his comment was that the railway companies lost sight of the fact that they weren't in the railway business. They were in the transportation business. And so if you think about oil and gas companies, essentially if they understand they're in the energy business, then maybe their decisions would be different than they are. And so the upshot of that is, if they do understand that, and if they want to behave in a responsible manner, we should give them money to permit them to make the transformation. Yeah, I agree.
Which takes capital. And Brookfield, whom we're associated with, has put together a fund for environmental or climate, renewal, and helping companies make the transition to a cleaner world.
And so that will be a growth area. If you ignore the returns, but look at it and say that renewable energy will occupy a greater percentage of world GDP as it moves forward, right?
Right.
So
it certainly is something that's going to grow. But when this thing started, like 5 years ago, the people who wanted to profit from it, I would personally say cynically, came out and said, if you invest in green, your returns will be higher. I don't think there's any reason to believe that in the short run or even the medium run. In the long run, it may work out that way. But there's no reason to think that green investments will make you more money. So the point is that the client may choose to make a conscious decision. I'll take a little less return to be a more responsible investor. Or some will say, don't overemphasize that. I want to make money. And that should be the client's choice. We bring to it our sensibilities, and we try to be constructive. One more thing I want to mention, which is maybe the most important, John, is that it's not all or nothing. And I don't think it's prudent for anybody to say, I'm an investor, I only care about the environment, I don't care about making money. Mm-hmm. Because if that's the way you feel, then really what you're doing is you're potentially engaging in charity. So I believe that we should try to make money, try to do it safely, and try to have a positive impact on the world, which means we have to kind of suboptimize on some of those things. If you go back 6-7 years ago, I guess it was, Germany said, we're going to go green. We don't want to have energy emissions anymore. So we're going to close the coal mines. We don't want to have nuclear risk anymore.
Right.
So we're going to close the nuclear power plants. And people would say, well, if you don't have coal and you don't have nuclear and you don't have an oil and gas industry, how are you going to get your energy? And they said, oh, it's easy. We're going to buy it from our friends, the Russians.
Yeah.
Well, guess what? That turned out not to be a good decision. And so my point is, my point is that you have to balance the interests. Yes, we want to make money. Yes, we want to be good to the planet. And I stress that adults make decisions which are hard and which are multifaceted. And, a kid will say, well, my goal is to get more ice cream. There's no but on that. Adults have buts. My goal is to be good to the planet, but I also want to have an effective portfolio.
So you've got a balance there. And I was going to ask you if you have any thoughts about, because one thing we haven't discussed much about is commercial or investment grade real estate in this environment now, which is obviously impacted by interest rates without question. And then in addition to that, especially in the U.S. and Canada, well, maybe around the world, I guess, the whole COVID response, return to work, hybrid work, and the need for office space, and then of course the issues related to retail have been going on for pretty well a decade. So when you look at real estate as an asset class, do you have any thoughts about what you see as the opportunities there, or risks?
Let's take office buildings, but just for that. So number one, as I said earlier, when interest rates go up, asset values go down. And that's true of stocks, companies, buildings, bonds, everything. Because when interest rates go up, demanded returns go up. And when the Fed funds rate was 0, people said, boy, I wish I could make 5. When the Fed funds rate went to 5, people say, boy, I wish I could make 10. So people's demanded returns go up, and in order to provide the higher demanded return, asset prices have to go down.
Yeah.
So that has happened, and that has affected all asset classes, including stocks, bonds, real estate, office buildings. However, at the same time, the office industry was hit by a fundamental negative, which is the pandemic and the lower level of working in offices. Of course, we don't know if that's permanent or temporary. 10 years from now, we could say, well, that was a crazy thing that happened to us around 2020 or 2023. But the point is, right now, there's less demand. Many tenants may have more space than they need because they're contracting their business or because their people don't come in. And over time, I think that may be fixed. We're at 3 days a week. I think we may go to 4. Someday we may go back to 5, in which case there's going to be demand for offices again. So, but at the moment, office buildings have the double whammy of higher interest rates and negative fundamental development. The top rank of the office industry is doing very well. And I had lunch with a friend last week who owns an iconic building in New York, and he's 99% occupied, and he's getting $220 a square foot for high floors. So at the top level, it's doing well. But poor buildings, antiquated buildings that are not up to speed aesthetically or technologically, they're suffering. And to bring them up to speed, of course, takes a lot of money. So, so that's on the other hand. But on the third hand, might these office buildings get so cheap that they're a buy, despite what's gone on in rates and despite the negative fundamental trend. And that's the tough call. It's easy to say that the office industry is troubled. The hard part is there a point at which you say they've been buffeted by higher rates, they have fundamental problems, but they're so cheap that we're compelled to buy.
Well, I would argue that is, I mean, especially if you're an institutional buyer, like if you're a large pension fund and you don't need to borrow any money to buy the asset, now the interest rate issue doesn't bother you. And if the cap rate on the building goes to 6 or 7%, for the pension fund, that's actually a pretty good result.
Yes,
Yeah.
exactly.
Yeah. So let me ask just one final question. So based on our discussions today, Howard, the sense I have is, I mean, I know that you guys in particular are expert at private credit in particular, but when we're looking at risk-adjusted returns, and we've discussed all of the issues of the environment we're in, and maybe interest rates might go back, but they might not go back soon. Essentially, what I hear you saying is that of these major areas in terms of returns, lending, especially lending on a higher risk type of loan, because of the environment we're in, provides a better margin than, say, many of the other options in the marketplace, which would include equity, either public or private, and real estate for that matter, depending on the kind of real estate, I guess. And so that private credit now is providing some of the most attractive risk-adjusted return features that you would see amongst all of the other asset classes. So is that a fair summary of where you are right now?
Yeah, yeah. Now that I absolutely agree, although that may not appeal to the person who is risk tolerant. Someone may say, yes, that bond has a very high probability of producing 12%, but I know a stock that might produce 25 or go to zero, and I like to throw the dice. So your 12% safe bond, that's a chicken investment. I'm not interested. I want the action. When you talk about risk-adjusted returns, they appeal to the same risk-adjusted return appeals to some people and not others, depending on their risk tolerance. But I think that for me and for other people who are appropriately risk averse, I always say to people come to me for financial advice, personal, my friends, etc. And I say to them, which is more important to you, keeping what you have or making more? And you know what they say? Both. Well, you can't emphasize both at the same time.
No.
If you're going to put an emphasis on making more, then you have to then you have a somewhat lower probability of keeping what you have, and vice versa. So everybody has to select. But I think that given the change in the environment, for people who are normally risk averse, I believe that we have great opportunities to make equity type returns with low uncertainty. And I think that everybody should, except for the most risk prone investors, I think everybody should push up the percentage that they have in debt now, and if the trends continue further, be prepared to do more in the future. I'm not saying you should do it all today, but today's a great time to start.
Yeah, I agree with you, Howard. So we in our firm, we run balanced portfolios, which include pretty well all asset classes, and we have made a commitment to change our. Typically, our fixed income component is about a third, so it's currently at 32%.
Yeah.
We've made a commitment to increase it to 38% over the next few months, and that's actually a fairly significant change. Yeah, and I think that that's going to be rewarding.
By the way, if you look at closed-end funds like we operate, there's a class of funds where you commit your money and they draw it down over a period of time as they make investments. I think that's ideal for this environment. because as I said, I wouldn't put all my money in today. But if you commit to a closed-end fund today, your money will actually go into the market over the next 18, 24, in some cases 36 months. So you will average your way in, which is a very appropriate thing to do today.
Right. Agreed. Howard, I think, unfortunately, we are out of time. We're probably a little over time. And I want to thank you so much for this time that you've given us today. It's been marvelous. And you've given a lot of insights to our clients that they really will appreciate. And we'll make sure they get not just your sea change memo, but the link to your website so that they can take a look at a lot of the other stuff that you write, which is also very good.
Great. Well, as I said at the outset, you have a really good understanding of what we do and why, which makes you an ideal partner for us. And we're very happy to be working with you, John.
Well, we appreciate that, Howard. And I want to talk to our guys about maybe seeing how we can increase our investment relationship with Oaktree, because I have a lot of respect for what you guys do and how you get it done.